Silver just dropped sharply in a single session, down more than 2%, and the numbers on the screen are flashing red. $90 per ounce slipping fast, grams and kilos following the same direction, and a wide daily range that tells us something unusual is happening beneath the surface. For many people watching the market this morning, this move feels confusing, even alarming, especially after silver had been holding strong at historically high levels. Is this sudden dip a sign that the rally is over, or is it simply a normal pause in a much bigger trend? That question is exactly why today's silver price matters so much. When silver moves, it doesn't just reflect supply and demand for a metal. It reflects trader psychology, currency pressure, industrial expectations, and investor emotions, all colliding at once. In this video, we're going to calmly break down what today's live silver prices actually mean, starting with the basics that most people overlook, like the difference between bid and ask prices, and why even a small percentage move can represent a major shift when prices are elevated. We'd also look at why silver is priced in so many units around the world, from ounces and grams to tola and tael, and how global trading hours can amplify volatility within a single day. Most importantly, this is not about panic or hype. It's about understanding context. A falling price does not automatically mean a failing market, just as a rising price doesn't always signal strength. By the end of this discussion, you'll have a clearer perspective on whether today's move is noise, a warning, or simply the market doing what it has always done, testing patience before revealing its next direction. The thing to understand about today, a silver move is what the live price actually represents and why it can change so quickly within a single trading day. The bid price, which reflects what buyers are currently willing to pay, has dropped noticeably, while the ask price, what sellers want, remains slightly higher. This widening gap often appears during periods of uncertainty, when traders hesitate and liquidity tightens. A 2% drop may sound small, but at prices around $90 per ounce, even minor percentage changes translate into significant dollar moves, which naturally grab attention. What makes this moment important is not just the direction of the move, but the speed. Fast declines usually indicate short-term positioning shifts rather than a collapse in long-term fundamentals. Many institutional traders adjust positions during active market hours, reacting to currency movements, interest rate expectations, or broader commodity flows. Silver, being both an industrial and investment metal, reacts more sharply than gold during these adjustments. So, before assuming something is wrong with silver, it is crucial to recognize that what we're seeing here is the market processing new information in real time, not delivering a final verdict on silver's future. As the trading day continues, the focus shifts from the headline price drop to how silver is behaving across different measurement units and ranges. When you see silver quoted per gram, per kilo, or even per tola and tael, it's easy to think these are separate markets, but in reality, they are all reflections of the same underlying spot price. A decline in the per ounce price automatically ripples through every unit, making the move feel bigger to retail buyers who track silver in grams or local measures. The day's range, stretching from the high near the low 90s down toward the upper 80s, tells a deeper story. This wide range signals volatility, not weakness. Volatility means the market is actively searching for fair value, with buyers stepping in at lower levels and sellers emerging near recent highs. This tug-of-war is common after strong rallies, especially when prices have climbed rapidly in recent weeks. Long-term holders often see such pullbacks as digestion phases, while short-term traders view them as opportunities or risks, depending on their strategy. What matters most is that silver remains well within its broader upward structure, even as it shakes out nervous hands during the day. As we move further into the picture, it's important to understand who is actually driving these intraday moves. Large institutions and algorithmic traders dominate most of the volume you see on the screen, reacting to macro signals like the dollar's strength, bond yields, and movements in gold. When silver drops 2% in a single session, it often isn't because physical demand suddenly disappeared. It's usually paper contracts being bought and sold at high speed. This is why you can see situations where the spot price is falling, yet coin shops and bullion dealers report tight supply or higher premiums. The paper market and the physical market do not always move in perfect sync. During volatile days, futures traders may be reducing leverage or locking in profits, while long-term investors quietly accumulate on weakness. This disconnect is critical to understand, because it explains why sharp red candles on the chart done T always translate into panic in the real-world silver market. Instead, they often mark moments of transition, where weak hands exit and stronger hands take their place, setting the stage for the next move. Another key layer to watch is how different price units tell different stories at the same moment. When the ounce price slips, it grabs headlines, but looking at grams, kilos, or regional measures like tola and tael reveals how global demand reacts. In many parts of Asia and the Middle East, silver is still actively bought in smaller units, and short-term dips often trigger buying rather than selling. This creates a stabilizing effect that doesn't always show up immediately on Western trading screens. At the same time, currency movements matter just as much as the metal itself. A stronger US dollar can push silver lower in dollar terms, even if its value is holding steady or rising in other currencies. That's why global investors don't just watch the price, they watch purchasing power. When you connect these dots, you start to see that a daily range between $89 and $92 isn't just random noise. It's the result of multiple markets, multiple currencies, and multiple time horizons interacting all at once, with silver sitting right at the center of that tension. Now shift your focus to market psychology, because this is where most people make costly mistakes. When prices move down quickly, fear spreads faster than facts. Traders see red numbers and assume something is wrong, even when the move is well within normal volatility for a metal that has already risen dramatically over the past months. Silver is not a slow, steady asset like bonds. It is known for sharp swings in both directions. These pullbacks often shake out short-term speculators, while long-term holders quietly add to their positions. What's important here is volume. If prices dip on lighter volume, it usually signals hesitation, not panic. But when heavy volume appears during a sell-off, that's when you pay attention. Right now, much of the pressure looks mechanical rather than emotional, driven by profit-taking and algorithmic trading instead of a fundamental collapse in demand. Understanding this difference can help investors stay calm while others react impulsively. As we wrap this up, it's important to step back and look at silver with perspective, not panic. Today's price movement, whether up or down a couple of dollars, does not change the bigger story overnight. Silver remains one of the most volatile major assets in the market, and that volatility is exactly what creates fear for some and opportunity for others. Short-term drops can feel uncomfortable, especially when headlines use words like crash or warning. But history shows that silver often corrects sharply before stabilizing and continuing its longer-term trend. The key is understanding why the price moved, not just reacting to the move itself. Physical demand, industrial use, and long-term monetary trends do not disappear in a single trading session. If you are watching silver, focus on structure, volume, and broader market conditions, rather than minute-by-minute price changes. Markets reward patience far more often than emotion. Stay informed, stay disciplined, and remember that in precious metals, survival is about strategy, not speed.
Hello friend, welcome to my YouTube channel. I hope all if you are doing great and having an amazing day. My name is Noor Baqi and I am really excited to start this new journey with all if you. You know, this channel is not just about videos, it is about story and ideas and inspiration. I created this channel to sharing something positive every signal week. Sometimes we all need little motivation, and sometimes we just need a good story to smile again. Decide exactly what this channel is all about. You find understanding stories, real life experience, and powerful lessons that can change the way you think. I be uploading new videos regularly. So if you don't want to miss any of them, make sure to subscribe to my YouTube channel and press this bell icon so you get notification whenever you post something new. You support means everything to me, and to great we can build a community full of partnership, learning, and good vibes. So sit back, relax, and let us begin this amazing journey together. Thank you so much for watching and welcome once again.